This is Caleb Barney, your local real estate agent in the greater Cleveland area. And today I wanted to go over a couple of articles because the Federal Reserve did just meet the past couple of days, January 30th and the 31st, for their first of eight meetings this year. And basically, it was a little hawkish talk still, in my opinion, from Jerome Powell, but overall, I mean, it's about what you would have expected for what they've been saying. They've been pretty consistent with that. So just wanted to go over a couple of articles today. The first one being from Housing Wire, where it says Federal Reserve holds interest rates steady for a fourth straight meeting. And then they have a subtitle that investors expect rate cuts to begin as soon as May. And that part was a little interesting to me. I follow a lot of different economists and a lot of different experts that their predictions have ranged all over the place. One notable housing economist, I shouldn't just say housing economist, but economist in general, works for Housing Wire, Logan Mohtashami, and he still thinks that there is a chance for the Fed to cut the federal funds rate about 25 basis points for their March meeting, which is March 19th and 20th. Other investors, as you see here, say that they expect rate cuts to begin as soon as May, which would be April 30th and the May 1st meeting. And then I actually just listened to a podcast yesterday where they said that they're not expecting any rate cuts until June, which would be the June 11th and 12th meeting. So kind of where I see it, I do think that it's still possible for March. I'm hoping that they'll actually cut rates for March just because, as Logan Mohtashami actually puts it in one of the podcasts he did recently, he said, what is the Federal Reserve, really waiting for? He thought that the last couple of interest rate hikes were actually unnecessary. But what he points out to, he's like, okay, so we've had all of these different months of data, and that's what I'm pulling up right now, showing that we are trending in the right direction. So how many more months do they need to see that, this is sustainable? And he's not necessarily saying go crazy with the, rate reductions or anything like that. But you could clearly see this is, personal consumption expenditures right here. This is from the Cleveland Fed and the median PCE inflation. But basically, you could see here, inflation for PCE really topped out in September 2022 for core PCE. That is, if you look at the median PCE, it topped out in March of 2023. But literally, it's been going down consistently, whether you're looking at median PCE or core PCE, every single month. The only exception where just normal unadjusted PCE, the personal consumption expenditures, basically corrected a little bit was June 2023 at 3.2% going to 3.3%, in July, August, and then 3.4 in September. But you could see that the core PCE, once they take certain items out, and the median PCE actually continue to go down. That's the Federal Reserve's favorite metric to look at is the core PCE. And again, core PCE is this blue line here, and it's been trending down basically since it peaked in September of 2022. So that's one measure of inflation. The other measure of inflation that a lot of people look at, not necessarily the Fed as much, but it's going to be the CPI, which is the Consumer Price Index. And the Consumer Price Index peaked, as you could see here, this is from St. Louis Fed, but it peaked in June of 2022, where we were basically looking at almost a 9% inflation rate, so 8.93 and change. And then that has actually been steadily going down too, with the exception here, same thing, June 2023, we had some really good numbers, and then it ticked back up before going back down. But to Logan's point there, he's basically saying, okay, so say you've had 6 months of positive numbers, like how much more data do you need to show that we're trending in the right direction and that it's sustainable? So he's like, do you need 7 months? Do you need 8 months? To feel okay decreasing the federal funds rate by a quarter of a point, basically. So that was his point, and I tend to agree with it. But yeah, they're basically keeping that federal funds rate between at a steady range of 5.25 to 5.5. So that was expected for the January meetings. Nobody was expecting it to decrease right now. But I am still hopeful that for March, especially just for the housing market, that as we enter into the spring and summer, home buying season, that we do get a little bit of relief. I know that the Fed, they have their mandates for basically, keeping inflation around 2%. They want a strong economy, but not too strong. And they would want to keep their unemployment numbers at a certain range as well. So they're not overly concerned about housing. Yes, they have to take into consideration, what housing does to the rest of the economy as well. And maybe that's why they are going to hold off on doing a rate decrease in March, just because they don't want to basically start off a frenzy or anything like that. So that's basically the first thing. Again, when will the Fed start to cut rates? Investors expect rate cuts to begin as soon as May, according to Realtor.com chief economist Danielle Hale. And then basically looking at CNBC, they had they didn't really have an article here. It was more just a bunch of different headlines. But basically it says Powell shoots down March rate cut. Federal Reserve left rates unchanged in January, but noted that it won't be appropriate to cut rates until it has gained greater confidence that inflation is approaching its 2% goal. Again, we're definitely approaching the 2% goal, but they just want to make sure that they're not cutting rates too soon, and then it goes back in the wrong direction. But they also have to be mindful of being too slow and being too restrictive and basically clamping down, on the economy here, because we want to avoid a recession if possible. So he's saying, hey, we don't have a growth mandate. We don't care, necessarily how much, the GDP grows, other than, hitting their target rates, basically. So they're looking for signs that inflation is on a sustainable path down. Higher prices have to be some part of low consumer confidence. Well, no duh. Of course, consumer confidence is going to be lower if prices are higher. And then he just says that a rate cut in March may be unlikely. So again, he's kind of talking hawkish, but he also is signaling out to the world just to kind of prep them, hey, don't go crazy. I'm not saying I'm going to cut rates or anything like that. And he almost has to play his cards, keep them close to his vest there. Because if he says, yeah, we're going to, cut rates, he doesn't want to encourage banks to lend, too freely or easily. Not that I think that they would be irresponsible for that, or people to spend, too much and cause inflation to go back up. So that's basically what we're looking at for the Fed recap for January 30th and 31st. That being said, I do look at mortgage rates daily, and I prefer to use Mortgage News Daily. There are a couple of different companies and whatnot that publish what the average rates are nationally. I prefer Mortgage News Daily. They are a little higher than, like, if you look at Freddie Mac's numbers, for example. But as of yesterday, what they ended at for the average 30-year fix was 6.75%. Um, you know, depending on the area that you live, depending on your credit score, your debt to income ratio, your assets, liabilities, all that fun stuff. I've seen people with interest rates considerably lower than that still. So this is just kind of a good gauge to see where interest rates are and if they're going up or down. And again, this is all good news because that third week in October, we are seeing the average 30-year fixed at about 7.91%. So, we're down, a point, 1.15%, 1.16% since that time frame. So houses are becoming a little more affordable. And that's why, I do think that it's going to be a strong year for the housing market. I think that we're going to, in the greater Cleveland area, see some appreciation, 3 to 5% appreciation in our market, which is healthy as opposed to the crazy, unicorn years during COVID where we were seeing double-digit growth, which just wasn't sustainable. So if you have any specific questions about the housing market, because again, I'm not an economist, I would love to talk with you about it. And whether that's in the, greater Cleveland area or Northeast Ohio or elsewhere, of course, my expertise is going to be here in Northeast Ohio, but I would be happy to have a conversation. Thanks, and have a great day.